All right, we are live on our website, on different social media pages. So, welcome. Good morning, everybody. Thank you for being here today. I appreciate you taking the time out of your busy schedules to come and learn. I'm getting some rolling eyes from the retirees in the room. Um, Thank you for being here. We sincerely do appreciate you taking the time to be here with us. We've got a lot of important information to go through. I think I know pretty much everybody in the room, so don't need any introductions here. But for those of you who are online, my name is Eric Hagan. I am a wealth manager. I am also president of Capital Consulting Group, or CCG. CCG consists of myself, of Chief Investment Officer Tom Fox, who we have here today. You'll be hearing from him in a few minutes. Also, financial advisors Dan Oshman and Rana Grant, as well as our client support team of John Knutson and Marilyn Westmark. Together, our goal is to help all of you, individuals, couples, families, make your next financial decision, and then the one after that, a good one. So, with that in mind, today we're going to get our monthly update from our Chief Investment Officer, Tom Fox. Tom is going to talk about the headwinds in the markets and the economy. He's going to talk about the positives in the markets and the economy. And then he's also going to put it together and use that crystal ball that he has to tell us what's ahead. So, for those of you that joined us last month, you know that it started to shift some of that information. So, we'll have a nice update on that front here today. Tom has an incredible resume. I'll let you read down that on the screen, but an incredible wealth of knowledge. We are all very fortunate to have him on the team and have him here today with us. So while you are watching, for those of you in the room, if you have any questions, I would love to have you write down that question, make a note of it. We'd love to do all Q&A at the end of the presentation here today. For those of you that are watching live online, feel free to post a question in the comments section wherever you're watching it, whether it's YouTube, Facebook, LinkedIn, Twitter, anywhere. If you post it in the comments section, I'll see it, and you can do that anytime, and I will get that to Tom at the end of the message. And then for those of you watching in the recording, same thing. You can post any questions that you have in the comments section, or if you visit our website, there's an Ask a Question button that should be there shortly after the end of this live presentation. So with that, I will bring it over to Tom. So, Tom, the floor is yours, my friend. Thank you.
Thank you, Eric.
Yeah.
Good morning. I think it's morning. Welcome those online. So I'm very excited to present today. We had an exciting day yesterday. Anybody know what happened yesterday?
They didn't raise
Couple.
rates.
2, 3. All right, Eric. Okay. All right. They did not raise rates. But our theme for 2023 has been this, that wag the dog means something of lesser influence influences something of greater influence. And the lesser influence, I think we put this on in December last year, maybe.
November even.
That the inflation rate will eventually move the bigger influence, which is the Fed, and they stop raising rates and maybe even lower rates. So wag the dog. That's been our theme for 23. I've been waiting. It's been coming a little later than I expected, especially after yesterday. We'll talk about that. But I still think it's happening this year. Okay, oil prices. How many know that oil prices have been rising? How many buy gas anymore? I have a Tesla, so I don't even know, right? So anyway, oil prices have been going up. And so these are the negatives. This is the trouble. This is the potential problems that are in the market. And there always is. Remember that stocks climb a wall of worry. And there's plenty to worry about. So we have rising oil prices, which can be negative on the consumer and also spending, because when you go to the gas pump and you pay more per gallon, that's like an additional tax you're paying to buy your gas. Now, student loan payments, which were on hold for the last several years, have just started in September. What does that mean? That a lot of the people that have student loans, and there's a lot of them, it's a lot of money, now have to make an additional $250 payment. And that $250 would go to discretionary spending is no longer there. And so there was a survey that talked about the condition of the students, and they said that they're worse off before, since they've cut off the payment. Now they're in worse condition, which means they're going to have to pick this $250 up at a really bad time. So that's a negative. Short-term U.S. Treasuries and 10-year yields are rising. After Fed talked, Chairman Powell talked yesterday, no interest rate jump yesterday. How many know that? They didn't raise rates. But his language, he had a fight with his wife in the morning or something because his language was very hawkish. And what does that mean? That they may still raise rates further. They didn't say they're not. They said we're going to be data driven. But the markets interpreted that he's still on a rate raising, campaign. So that was not good. So that's becoming competition for stocks. Right now, if I can get a 5% or a 4%, 3.5% yield without much risk in the bond market, or even short-term bonds or treasuries, why would I risk going out and try to get it maybe 10% from stocks? So that's a competition. The Fed will be tight and hold rates high for a long time. Now, some of these are something we actually agree with, not all of them, but some of them we do. But I'm just bringing all the wall of worry that's out there. Government shutdown. How many have heard about that? That the government's about to shut down. This happens all the time. We'll see what happens. They always seem to come with 11th hour solution. This one looks a little, maybe there's a bigger barrier to that because of the divergence in certain people in the government, but that's a possible. And how many know the UAW strike, the auto strike happened? Now I heard today that they're getting closer to solving that, but that could be a big hit on the economy if that is extended, the strike, labor strike. So another one is China. China could take longer to recover. If China is prosperous, it typically will come over to the United States and help us be more prosperous. If they're not too prosperous because of the globalization, then what happens is that United States may suffer because they're not doing as well. So that's a possibility. Borrowing has been dramatically higher. A lot of small companies need money. Maybe they had loans coming due. Certainly real estate is in trouble because if you look at the number of loans coming due, low interest loans for commercial real estate, it's a huge number the next 2 years. And if rates are this high, it could cause a lot more default in their ability to make their payments for their mortgage, for their properties. All right, and small companies could struggle getting loans that make sense. We all been used to very low rates. And now that could change, has changed, and we'll see what happens because we have a lot of small companies. They're going to have to refinance at 3 times maybe what they were before. So that's going to be a problem on the economy. In the past, historically, when the Fed goes on a interest rate hiking campaign, that typically leads to a recession. Now, we have been bullish all year, except for August. We called that there would be a pullback, and we did get that pullback in August, but we've been bullish all year. In fact, we set a target for 4,600 in the S&P, and we did reach that. Very few money managers or strategists can say that. So we did call that right. However, if the Fed overshoots, then, and there's a delay when they raise rates, the economy doesn't immediately react to the higher rates. It's like a ship, big liner coming into the dock. They hit the brakes a mile, 2 miles out to start slowing down. So there's a delay effect of what they did in this past year. So that could end up coming and hitting us harder than expected. And that's been typically what happens. Inflation risk still looming. We got rising oil prices, strong labor market, and other consumers continue to spend. So the economy is doing well. And sometimes when you get good economic news, it's bad for the market. good news is bad news. And so, because what that means, well, maybe the Fed will raise rates more because the economy is doing so well, and keep rates higher because the economy is doing so well. And it is doing well today, to date. All right. So delayed impact of shock coming to the economy. Overall, strategists have been negative pretty much all year. And we have not. We've been bullish and the market's hit 20%. We've got some strategies up that we've been up close to that 20%, like the wide mode. And so our thematic has been up about 15, 16, 17%. So we've captured that. But things may change, and we'll talk about that at the end of our presentation. All right. Are there some positives? So there's a few. Inflation is still on a glide path lower. Overall, deflation is still seems to be the main order, but there was that oil price impact on cars and some other and gasoline that impacted last month some of the CPI numbers that kind of went up just a little bit, but the glide path's going in the right direction. That's a positive. September downturn in stocks may be front loaded. Maybe we're going to recover later on this month with the remaining days or in October, because most of that front end kind of little mini downturn may be behind us, but we'll have to see. Stocks typically rally after the Fed stops. That's when the tail wags the dog. And it hasn't happened yet. Now, it's taken longer than I expected, but we still think it's coming this year where the Fed will not be raising rates. As soon as they say, hey, we're done, we're going to look at a chart. Historically, that's been very, very positive for stocks and bonds. Because once they say, hey, we're stopping, we're not going to raise rates anymore, now we're going to be thinking about lowering rates in the future at some point. That's very positive for stocks. Another thing, if you look at FANG, which is Facebook, Apple, Netflix, Google, these are the tech stocks, plus some others, have been the main weight of the S&P 500 or the indexes that has driven this market upward. We own a lot of those. However, if you look at the other stocks outside the technology stocks, their valuation is not overly expensive. What's expensive is the tech stocks, but it doesn't go through in terms of breadth to the other stocks. So overall, most of the stock market is not expensive, especially after the recent several days we've had. Another possible good thing is that, again, we're coming to the end of our hiking cycle, and AI productivity is going to start hitting the companies. They're right now using generative and cognitive ability of AI to help their businesses become more efficient. You don't need as much labor because it will do a lot for them. And now they're building out software that will help take that breakthrough in artificial intelligence and make their companies run more efficiently with higher productivity. That's still coming. That could take a couple of years, a year and a half, 2 years to really hit the corporations, but that's a positive. And the US is leading that way in that particular venture in technology. So the Fed has done huge amounts of cash on the sidelines. If you look at, we're going to look at a chart, how much money is out of the stock market into money market funds. It's a huge amount, both retail and institutionally. And some of the smartest money in the world, hedge funds, institutional funds that have big money, very smart people, have been out of the market most this year. So they've been bearish. They've missed most of this run, and now they're still bearish. So they have a lot of money on the sidelines. Well, if things start to turn, for example, the Fed says we're done, they say that or suggest that money may come back in the market. There's plenty of money, what we call dry gunpowder, to come back into the market to boost returns going into the end of the year. So that's a big one. Overwhelming number of investment strategies have been bearish again. What that means is it's a contrarian indicator. When you have that many smart money bearish, what it means is that you push the spring too far down and it could really pop up if the sentiment changes. So that could be a contrarian indicator. All right, markets can move faster than expected when Fed says we're done or suggested. And we're going to look at a chart here, lots of cash on the sidelines. This is a lot of things on here. But if you look at this is when the Fed, Volcker back in 82 said, I think we're done raising rates. Look how fast and powerful that stock market moved. That could happen this year. If the Fed says we're done, the inflation numbers that are coming out over the next few months indicate that it's really getting into their 2% target. That could happen very fast. In fact, it went to an all-time high in 1 month, canceling out all the losses. This is how, and there's plenty of money again on the sidelines for this scenario to unfold. That's why we're still bullish to the end of the year, because we think the Fed will say they're done sometime over the next couple months. Here's the massive amount of cash. This is the institutional money, the retail money. Here's the COVID panic peak. But look where we are in both institutional money sitting there waiting for it to invest it in stocks. And you can see how big that number is. That's why anything that turns slightly positive by the Fed, this money could go to work back into stocks, pushing prices back up. So that's a potential here. Deflation is repeatable and leading to falling CPI. I got a number of charts on the CPI, which is the measure of inflation, that are showing some of the major components within the CPI are about ready to really bring down the CPI. So this is the consumer inflation expectations, and we're down to 3.1, which puts us at pre-pandemic from March 21, 3.1, and that's falling. You can see it rolling over, and you can see how much red is here. So what the consumer is saying, we think, and they're out buying, that's us, we're out buying. They see prices are going to be down in 1 year from now. Even the long term looks very similar. A large percent of CPI already deflating. Now this is that 30% is in deflation, 50-year average. Of all the components of this that make up the CPI, 30% are deflating. That's about normal. If you look at the 10-year, it's 38%. We're at 44.2% of the CPI that's going down in terms of lower inflation. That's a good number. What this tells me is the Fed is maybe not current on their decision making, and we're going to talk more about that, because there's a lot of things deflating, and there's this number we believe is going to go up quite a bit, which would be good for the CPI, which means the Fed can stop raising rates and even now start thinking about lowering rates in the future. Used car prices is a big component of the CPI, the inflation rate. It's about ready to roll over big. Could have a big impact. This was one of the big contributors to high inflation, was the cost of used cars. How many are ready to sell your used car? Do it quickly. Because we think it's going to come down, and it's a big component in the inflation rate. So we think that's coming down. And then, of course, a big one is shelter. I was just listening to an economist, very well-known economist on CNBC this morning, who is the one that realized that when you get an inverted yield curve, that's where short-term rates are higher than longer-term rates. That 8 out of 8 times that leads to a recession. And he was saying that the Fed's looking at the shelter in the wrong way, because it's already flat or maybe 1% if you in real time. Now there's always a lag to finally get to the government number of the CPI. If that is true, if the real-time shelter number is maybe 0 to 1%. That would drop the CPI lower than the 2% target to about 1.8% for the over CPI. So we got used car prices coming down. We got shelter in real time already down. But there's that lag effect before it hits the CPI number. So that could be suddenly, and I don't know what that lag distance is, but it's coming. So you can see negative. Now, going back to this number, that's kind of taking both of these. Is this repeatable? Well, the forecast is that both shelter and used cars will probably be negative going forward as we go into next year. Fed doesn't have to raise rates anymore. They're going to start lowering rates because of the damage that was been done by raising rates. This is good. So we believe that the CPI rate will catch up with the reality and its prices are coming down. And that will change them from being hawkish, raising rates, to dovish. Everybody say dovish. That's where they start thinking about lowering rates. Everybody would rather have a dove than a hawk, right? So that's what we think is going to happen. Consumers are starting to show some fatigue, and this we believe is going to continue downward. And we'll talk more about that at our last charts. But the consumer is starting to slow down a little bit in their purchasing. We've had excess savings. Why did we have excess savings? Because of the pandemic, everybody stayed home. They didn't fly, they didn't go anywhere, they didn't eat out, they didn't go to the movies. They saved money, and so the excess savings went up. Well, a recent investment research said that money's gone, that all the excess savings is gone this quarter, which means they won't have that extra money to play around with. Now they're going to have to make some real decisions on what they're going to be doing. So we think this is going to continually go down, which is what that means. The Fed can go from hawk to dove. Everybody say hawk to dove.
Hawk to dove.
All right, you got that? All right. That's all good. On the other hand, I got everybody say on the other hand. We see oil price jumping up here. If you look, it's over $90. But you can see for interest, this is interesting. Natural gas is not so much. Of course, in winter, those prices go up because it gets cold and everybody starts using more natural gas. So why did this happen? We think it's temporary. You can thank everybody say, I thank Saudi Arabia. I thank Russia. Those two got together and have cut production. So they're not producing as much oil. Supply, demand, what happens? Prices go up. That's a very temporary number. It's not based on economic demand. China's been slowing down, so that means they're using less oil. So this all has to do with politics. The reason that oil price and your gas at the pump's high right now, it's all, every time you go, thank you, Saudi Arabia, to that pump. So we think this will go back down. It could go higher, could go to 100. I mean, that's not a disaster, but it could go higher. All right, starting to slow, more signs of slowing the economy. This is the labor market is gradually softening. One of the big things that the Fed's been so hawkish or tight with interest rates is because the jobs market has been excellent. And that hasn't changed. There's a lot of people employed. That means they're making money. That means they can go out and spend some money. But it is showing a 3-month change. It's starting to head down. We think that's going to continue. So all of the things we've been kind of looking at, I believe, is where the tail wags the dog. All these indicators are showing that the Fed is going to, this year, will stop raising rates. Another one is the expectation for a Fed. Now, this changed yesterday, so this is old. How many know this is old? It's the Fed meeting kind of put a thing in that. But the expectation is for 1 cut by in the middle of the year and 4 cuts in the interest rates by the end of the year, next year. That will be good. Now, we think it's going to happen faster, and we'll talk more about that. Any questions so far?
Should have slide that said that consumer spending is going down. I'm a little bit confused when you say consumer spending is going down, but yet you say that there's huge amounts of cash in the sidelines.
But their cash is about their investing pattern. It's not about their spending.
Okay.
You can have cash in your bank and not go out and spend it. But this is more money set aside for going into stocks or bonds. It's not for going to Disney World. Okay, future of artificial intelligence. We're just going to throw this up. This is huge. We got generative AI coming, which can create things from, you can ask it to create things for companies. Then you have the communication of AI where it's natural language. You can talk to it. I use AI on a regular basis now because I can speak to it and it will give me data that I need. So I do use AI, and this is going to change our world. And it's going to become more and more employed into our daily life. It's gonna make life easier, but it could be used, you hear about all the negativity that it could be used for evil. Well, that's always going to be out there. But eventually it's going to change kind of your daily routines over the next 3 to 5 years. So that's coming. And these are different super cycles. When the mainframe came out, that was IBM. PCs came out, then networking, the cloud over here, mobile internet. And now this is a generative artificial intelligence, could be another super cycle in the economy. So technology could change everything economically. Now, I don't see that really having a big impact until the end of next year. And then going in forward from there. But it's coming, which will help companies be more profitable, increase their revenues, make your lives easier, and so on. But that's coming. It's the next big wave. So that's kind of exciting. So here's the productivity boost. Remember when productivity gets boosted, company earnings do better, company revenues do better, company stock prices go up. So you can see it's going to really help banking, education, healthcare, high tech is going to do fantastic, insurance and so on, media, entertainment. And there you can see the darker colors means the high impact. So there's a lot of industries that are going to do really well as they employ AI into their systems. Now, a lot of companies are hiring people. If you are AI software guy or woman, you can make close to $1 million a year. Any AI people here? Because they're really looking for people that know how to work with AI and how they can take this revolutionary breakthrough and apply it to their own company and their own employees and obviously their clients. So they're trying to figure it out right now. It's probably going to take a year to two, but this will be a big boost and it could be a super cycle down the road. Okay. So what do I see coming? This probably changed as of yesterday. And this is only good today. Economic outlook for the balance. Inflation continues to fall. We do believe that. Fed rate hikes most likely over. That will be good news. They haven't said it yet. They even kind of hinted the other way. We think that's going to change. When Fed hints to be done, stocks rally to the end of the year. This is the tail wagging the dog. Bond yields start heading lower. That's later this year. Good for bonds. Huge amounts of cash on the sidelines enter, bolstering the second half. The end of the year rally. Shouldn't say second half because we're farther along. S&P, I still have 4,900, but can you read these words? A lot of fear and trepidation. I was right on the 4,600. Now, this all is dependent on the Fed saying we're done. If that happens, money's going to flood in. Stocks peak sometime in December or January. That's sort of an update target. And then our surprise forecast, which we talked about last time. Now, remember, we've been bullish all year, except we said August would be bad, and we were right. Here's our surprise forecast. I don't know if looked at this last week. I'm more convinced of this. 24, first quarter, first half, household pandemic savings they're gone. We talked about that. Student loan payments are now going to have to be paid. Consumer spending after Christmas slows significantly. That's what I see happening. Service PMI, which has been doing really well because everybody's flying, visiting their relatives, going on exotic trips like Eric. And then that's going to contract. Like manufacturing is already in a contraction mode, but now the service side, which is expansion mode, is going to roll over. People are going to tighten their wallet. Fed aggressive rate campaign overshoots. And after yesterday's meeting, I'm more convinced of that. They're going to overshoot this because of the delay effect of the economy. And they've done it almost every time. They've got a really good track record of not getting that right. Remember, they didn't raise rates fast enough at the beginning. Remember, inflation was, what was the word? Transitory. And then they finally realized it's not transitory. We need to, start raising rates. And we've been on a acceleration of rates ever since. They got it wrong. And I think they're going to get it wrong again. And then next year, something, not immediately, but maybe second quarter, corporate earnings fall significantly. Stocks go into a correction or possible bear market. In the first half of 24, bonds rally, stocks go down. And then comes a recovery towards the end of the year. Now, that's a long ways out, but that's what we see happening. Now, we didn't say that for this year. Many said this is happening in 23. We didn't say that. We said we're bullish. We see it now coming next year. And so what are we going to do? We won't adjust your investments until we see confirmation of data towards this. Then we're working on coming up, how do we make your investments more secure in this kind of a scenario unfolding? We're not there yet. We want confirmation as the data comes. We're like, the Fed's data driven. We're data driven too. So we need to see confirmation. I wanted to get this on paper before anybody else did. So I think that's it.
Yeah. Thank you very much, Tom. Just a reminder, anybody online, if you have any questions, go ahead and put it in the comment section. I see you out there. Would love to field any questions. And then, of course, anybody in the room, anybody have a question? Rob.
Oh,
You
okay.
mentioned consumer spending slowing down and
Yeah.
the savings growing. I'm hearing that wages are lagging a lot compared to inflation. Does that contribute to that? And you see that fixing itself soon?
Yeah, I believe it's going to make that adjustment. I think that's a big lag effect there. Right now, because people have hired, and then we're coming into Christmas, right? I think Christmas is the last hurrah. Amazon's hiring 250,000 employees for the Christmas. Now, if that disappoints, this could start to unwind earlier. But I think after Christmas, people are going to pull back significantly, and then wages will, get unemployment. It's a cycle. This thing happens, then this happens, and so they start laying off people, and they can do it very fast.
I'm worried about the UAW strike. Now, I think it's gonna go on for like 3 weeks. And, and some of the smaller suppliers might go out of business, because of that.
Very possible. The Fed didn't seem moved by that. They didn't lighten their hawkish narrative, which was, they were asked the question. They said, well, we'll see. So, and they're going to be data driven. So we'll see if data happens, it doesn't get resolved, and then they'll see. It's not a big percentage of the overall economy. It's like, it's a very small percentage of the economy, so it's not a major percent. So I don't think they're too worried about it, even though if it does happen, it's too bad for all the employees of car manufacturers, but it's not a big percentage.
Plus,
You see the digital dollar affecting anything?
Eventually. They're gonna come out with ETFs pretty soon. So you can buy the cryptocurrency through ETFs. I think it's just too early. It's too volatile. But I think it will eventually affect everything, but not now.
Right, not now, all the timelines.
Yeah, maybe within 5 years. But not now. And you have to have stability in your currency. I know there's an island in Asia where all they use is Bitcoin. Well, I just sold some product to my neighbors. They do it all on the phone, but then Bitcoin drops 40%. It's not a good idea. Because you want your dollar to, whether it's a Bitcoin dollar, to be stable. And so far, there's no stability in Bitcoin. A very small percentage of Bitcoin is actually used for transactions. It's all speculation. And what we think in this room, Bitcoin's worth, all of us, that's what it's worth. I don't like it. Warren Buffett doesn't like it. I just don't like cryptocurrency. But down the road, governments, will probably go there. No, moneyless society, which the Bible predicts. So I think it's going to happen.
You mentioned China, good for China helps us. You didn't seem to make it a huge factor, but I hear people talking about it, it's, with us saying we want to bring manufacturing back and China's current economic problems and others wanting to put tariffs on their goods for political purposes. Do you think that's going to be a major factor for all of this? It seems like it has the potential to be a big factor.
Yeah, I think it's a slow drip, kind of. Doesn't happen overnight because we are very globally interconnected. So, but I think China, if you look at the chart, I think I had one last time maybe about the chart that showed that China's percent, or I did that on an advisor internal
oh,
thing I send out.
our preview.
Yeah, but what it showed was China here a year ago, this is the percent of importing from China. That's dropping off. In fact, Canada has passed them. Mexico has passed them. Vietnam and the other little countries have already passed China. And I think that's going to continue. A lot of it has to do with the restrictive communist Xi, who is, getting his fingers and controlling everything. That's not going to be good for their country. So I think it's going to just keep going down. Now they may have a internal rebound from where they're going. They have huge real estate problems. They got empty, massive real estate projects sitting there, ghost towns. And a lot of them are going bankrupt. All of that is a problem. That's good, in my opinion, because it keeps them busy with their own problems so they don't go and take Taiwan. That's probably good. I think President Biden said, hey, he's very busy right now. He's not going to go get Taiwan.
What impact the attempts by some countries in the world now to replace the US dollar as the standard for global commerce have on our economy, our stock market, our future?
Well, the death of the US dollar has been predicted for 25 years. It just hasn't happened. And right now, our dollar is stronger than ever because we're the cleanest shirt of all the dirty shirts of all the nations. If you look at our dollar, it's going back up. And they've been trying to move it away. And a lot of nations want to use their own dollar instead of the US. And that's eventually going to happen. I don't know what the long-term impact is for that, but I've been hearing this for as long as I've been in the business. It probably will the US dollar use will probably go down eventually. Maybe we'll have one world currency,
You had a chart on that last month,
Right.
actually,
one world currency. Did you find that?
on China, on the use of the dollar.
Did I use that? Was that in this or was that a? internal?
It may have been 2 months ago,
I think it was internal,
was it?
maybe a couple weeks ago.
Well, as far as the currency, the dollar.
Oh, the currency, I did that a while ago.
Is that
Yeah, it showed
Is
the,
that July?
yeah, it was a while ago. Yeah, it just showed the US currency is still the main currency. Conspiracy theories have been there. The gold people, the gold bug people like that. About the dollar going, into the pot. And so we gotta buy gold. And so they've been saying that for years. And gold, fluctuates within a range. Cryptocurrency kind of took over, started taking money away from the gold purchases. So you buy cryptocurrency, but cryptocurrency, when the stock market goes down, it goes down further. So it's not even a hedge. Cryptocurrency is here to stay. I just think we're a long ways off. And I don't know what the impact's gonna be personally.
But you're watching.
I'm watching, yeah.
Anybody else? I don't have any questions online. Last chance for those of you online, if you have any questions. I'm watching that section there. Any other questions in the room here? Otherwise, we can get some lunch going. What that's, you got another one, Keith? No? Anybody else? Going once? Done. All right. Well, thank you guys all so much for being out here. I'll go ahead and close up our presentation. We, of course, will stick around and answer any questions that you guys want to ask one-on-one. But we do have lunch waiting. Marilyn got lunch for us again. So look forward to that. So for those of you online, just remember, if you have a question and you're watching this in the recording, feel free to post that question in the comments section. We will be glad to circle back with you. And then just a heads up, you can mark your calendar. We are back here just over a month. Wednesday, October 25th will be the next monthly capital markets update and outlook or client check-in. Speaking of AI, Tom is going to be working on his shoulder. So Tom's going to be the bionic man a little bit more here next
So
time.
am I, yeah, I'm going all out bionic.
Yeah.
joints.
So we'll have
This
Tom
is next.
virtual next
And
month.
then this is following, then I'm done. But yeah, I feel good.
Keep him in your thoughts and your prayers as he goes through that. But
More in the prayer.
more in the
not
prayer,
just-
yeah.
Going into,
Huh?
what,
I'm gonna get a shoulder replacement
a show?
October 4th, so I won't be here physically next time.
We will be live in person
will
for those
do
that
it
want to be here for
online
lunch, but we're gonna have
with
Tom
my
up on the
little
screen.
Strap here. Pulling.
Oh,
Home
Yeah,
office.
I
Yeah.
think it's
well,
six.
you start going down here to the
Well,
shoulder,
six
hip,
weeks.
knee.
Well, then in January, and then I'm done.
Yeah, there's
You only have to do it once, so I'm done. I ended up with bad joints, over the years, so.
Parts
Too many sports.
Howard's doing it twice.
Oh,
Yeah,
He's having his replacement replaced.
oh, that doesn't sound good.
I got the third knee replacement coming.
Okay, third. Hopefully I never have to reach that. I mean, this one's great.
His was a long time ago.
Oh, okay. Oh, yeah. Today, I don't think I'm done.
It's better. now.
Yeah. But once they recover, it's phenomenal. I don't have
That's
any
what they
pain.
say, yeah.
Yeah.
All right, for everybody online, we'll let you go. Have a great rest of your day. Again, thank you for being here.
So pray for me. October 4th. Save them.